Can you tell me a bit about your investment background and how you came to be at Credit Suisse, and what it is that, if there are any particular influences or styles that impact the way that you think about investing?
So my background, economics degree and chartered accounting. I got qualified with KPMG and always been interested in the markets, and particularly the Aussie share market. So I sort of targeted my career to somehow getting involved with shares. I didn't quite know how that would manifest itself, but I ended up at Bankers Trust. There's a lot of ex-Bankers Trust people in the market. You run into them all the time, but it was a great shop to start at. And then my career was Aussie equities, so with a couple of other institutions. And the approach then was growth Aussie equities. And then the opportunity came up at Credit Suisse. And originally, it was multi-asset class portfolio management. And my particular value add back then was the Aussie equities angle.
Mm. Do you remember your first investment or the first shares that you bought?
Yeah, very well. So back in the day, Westpac was prior to Bob Joss joining. So Westpac was in a lot of trouble. And there were concerns around whether it would be a going concern. And Kerry Packer was lurking. And I'd learnt in economics that it was very unlikely that the government would allow a bank to fall over. So I thought, how low can it go? So I bought Westpac back then in the 80s. And then Bob Joss joined, and he really turned that ship around, did a tremendous job.
So it was a good experience?
Yeah, so that was a good experience. Yeah, that's right. Yeah.
And have there been particular individuals that have influenced the way that you invest?
Probably my first boss, where I was actually analysing Aussie equities, a fellow called Don Lowe. Not many people would know Don, but he's one of those quiet achievers in the market. And probably the main thing I took from him is a very simple philosophy on investing. Back then we were focused on Aussie equities, and his approach was good companies tend to stay good and bad companies tend to stay bad. And that's a philosophy that's actually worked quite well for me over the next sort of 23, 24 years.
Nice, simple approach.
Yeah. But otherwise, I don't try and limit, it's very fashionable to quote Warren Buffett and other people like that, but I just like to take little bits of wisdom from wherever I can get them. So
if you were to explain to someone how you think about investing or the philosophy that you employ for the clients at Credit Suisse, what would be your little elevator pitch, or how would you describe what you do?
An elevator pitch, I would say our broad philosophy is if you look after the downside, then the upside will look after itself. So what I mean by that is when you're creating a portfolio, you should always ask yourself, what if I'm wrong? What's the risk in this portfolio? If something did go wrong, what's the downside? So we spend a lot of time with clients talking about what's the potential downside for any sort of investment that we're discussing. And I'll give you an example. During the GFC, our balanced mandate fell by 17%, but it got it all back within a year, which was a really, really great result. And looking back now, what we did well, I can't say that we were particularly bearish on equities coming into the GFC like everyone else. So I can't say we were particularly negative on equities, so we had a full allocation in the shares. But what we did do well was hedge the risk. So we had a full allocation in the bonds, quality bonds. The other thing that we did is that we didn't hedge our international shares. So the good thing about the Aussie dollar is that when share markets are weak, it tends to be weak. Of course, the Australian economy is leveraged to global growth. And so what that means is if you have US dollar investments and you're not hedged and the Aussie dollar falls to, 48 cents to the dollar, as it did back then, when you translate your US investments back to Aussie dollars, it's much more attractive. You're getting a pickup. Yeah. So it acts as a buffer. So we didn't hedge any of the international equities because we were a bit concerned about valuations and whatnot. And that worked well. And the final thing was that we thought if we're wrong and we could see debt building up in the system, we didn't quite know what would prompt a fallout in debt markets. But we looked at where was the debt, and we could see it in property and property stocks, property trusts, particularly in Australia. So that was the third thing that worked out well for our clients, was having almost no exposure to property trusts. And I don't know if you remember back then, Centro basically almost went broke. Goodman Group.
There was the Babcock Trust.
Babcock, all these things, under terrible pressure. And what a lot of them were doing was borrowing in Australia, buying properties in the US, hedging back the properties to Australia and picking up a bit of a yield differential. So they were leveraged to their hilt. They were buying some pretty obscure sort of properties around the world and using financial engineering to hedge it all back. So that for us, that was a good example of that philosophy, is always thinking about what could go wrong.
Where do you see the debt build up at the moment?
So if you look well, Australian balance sheets,
it's with the consumer, right?
It's with the consumer, that's right. So look, that's the bad news. When you look at the median salary and how much of the median salary is required to pay the average mortgage, it's at all-time highs. But if you look at the serviceability or the servicing ratios, as long as interest rates are low, the amount of salary that the average salary earner has to apply to their mortgage is actually still quite low. It's still quite controlled. So that's the key. That's the key. As long as interest rates are falling, then we're going to be okay.
People have jobs. People
have jobs. That's the other thing, and that's really what prompted the RBA to move. Unemployment rose, and if you look at the job ads, if you graph, doesn't matter which one, ANZ or SEEK job ads, and you trend line it, it's coming off quite rapidly. So I'm sure the RBA were saying, okay, we've done nothing for 22 months. What are we going to do this month? Well, we really need unemployment. That's changed, and that's if you get unemployment rising, you've got a weaker housing market. That's a recipe for some big issues. And we saw it in the bank results that arrears were rising. But the good news is the RBA have acted. APRA are making it easier to get loans. They've changed the rules around the stress testing that is applied to a mortgage applicant. And also, with the LNP victory, if their promised tax cuts get through, that'll be stimulatory for the economy overall.
A fine balance, I'd say.
Look, things aren't disastrous in Australia, but I think it's telling that you've had RBA, APRA and the government all acting in unison and all pretty quickly and within a couple of weeks of each other to try and arrest the fall in the housing market and stimulate employment.
Yeah.
So I think that says it all.
Your role is very much about helping to guide the portfolio and the portfolio construction and the asset allocation for the high net worth individuals that use Credit Suisse. What are some of the biggest misconceptions or the traps or the sorts of behaviours that you see or that you see yourself as being able to help private investors with? What are some of the things that you think that people get wrong consistently and where you guys can add value from that advice perspective?
I think that putting a structure around investing is a starting point. It might sound obvious, but we do find even family groups who you think might be quite sophisticated, they're not quite as sophisticated as they should be. So having a philosophy, our broad philosophy is multi-asset class investing is the best way on a risk-adjusted basis to achieve return goals. So, whenever we see a new client, we always say, what's your philosophy? What are you trying to achieve? And we tell them, here's what that means for risk. And we go through different measures of risk and what that means. It can mean different things to different people.
What are some examples? Can you talk me through a couple of examples of
one of the things we do is we always refer back to the global financial crisis, and we'll say, well, okay, so you're trying to achieve CPI plus 3%. And we might say, well, look, the balanced portfolio or the balanced mandate is probably the best portfolio for you. But we'll say, but keep in mind, in the GFC, the portfolio fell by 17%. Can you cope with that? And if they say, actually, no, there's no way I could cope with that, we'll say, well, you need to reduce your return expectations and you need to take less risk. So the reason we do that, I mean, there's another measure of risk, is just simple volatility, standard deviation, and also maximum drawdown. So you look at what was the drawdown from the very top of the portfolio performance to the very bottom in any period, and because it's another measure of what potentially could happen to the portfolio in a crisis. But the objective of all of this is to prevent a client selling at the bottom, because if they look at the portfolio and it's dropped 17% and they go, oh, I can't cope with that, sell everything, that's exactly the wrong thing to do. Yeah. So that's, if a client's thinking like that, we haven't done our job.
So at the core of it is you're trying to overcome some of these behavioural biases and this sort of loss aversion behaviour that people have built into them.
That's right. So I don't want to sound cliche, but we're trying to make our clients smarter investors, better investors, and that's probably the key to it.
So at the start of 2019, you wrote an article on Livewire, or it was for your clients, and you were able to share it with readers on Livewire, which was called an Optimist Guide to 2019. And you outlined half a dozen or so factors that you felt could lead to a relatively positive year for investors in 2019. So we're at the halfway point. It's been a pretty good year so far for returns. And we've had a couple of interesting developments. Trade wars are escalating at the moment as we speak.
Yep.
Expectations are building that the US will cut rates. And as I looked at the Bloomberg screen this morning at the US Treasury yields, they're inverted as of this morning. And we've also had the rate cut from the RBA in Australia. So I'm keen to get an update as to whether you are still feeling optimistic or you see reasons to be optimistic about the investment outlook from here, and maybe talk through some of the ways that you're thinking about allocating in this environment.
Yep. So we're still optimistic, but just putting that article in context. So Q4 last year was very poor. Double-digit falls in most share markets, and things were looking pretty grim. So I was a bit sick of the pessimism, and I thought, let's put out this article about being optimistic. And as it turns out, it's been an incredible year so far. And actually, share markets have gotten back everything they lost and have picked up more. So maybe if we look at why share markets have done that, and there's a few reasons. But the main reason, the main difference, and we sort of alluded to this in the article, that central banks won't sit on their hands if things deteriorate, and that's exactly what's happened. So for the Fed, from going from a position where they were saying the next move in rates is up, to one where they've said very likely to cut, and also, by the way, we'll do whatever it takes to prevent a recession, which means money printing. We had the ECB change tack as well. We've had the Japanese continuing on with their money printing and keeping rates low, and now the RBA have joined the party. Now you've got to remember, the RBA only a month ago, they were still saying we see the risk skewed to the upside in terms of employment numbers, and we expect inflation to track towards that 2 to 3% band that they have as a target. And all of a sudden, last week, Governor Lowe, or the week before, sorry, in a major speech, said we will consider rate cuts at the next meeting. So that's the dramatic thing. So you look at that and you say, well, okay, what's happened now is that share markets and bond markets have all risen in unison, and valuations are stretched. You have to say that. So you've also got seasonality, and I know it's a bit of a weird one, this idea of sell in May and go away, but you look at all the evidence, and 7 times out of 10, it's the correct approach selling may and go away. That's a discussion for another time, but one of the reasons it's possible because you've got the Northern Hemisphere summer holidays coming up.
Yep.
And so investors tend to close out their books and take risk off and then put it back on near Christmas. So we often get a Christmas rally.
Yeah.
So what we're saying at the moment is because of central banks acting as a backstop, because the Chinese, they've got the issue, the tariff issue. That's a real worry. That is definitely a worry. But they have shown themselves adept at managing their economy to avoid recession. So we have confidence in the Chinese. That, sure, I think we'll get maybe sideways, maybe slightly down between now and sort of September, October, November. But really, all the building blocks that created this massive run in markets so far this year are still there. And we think they'll reassert themselves towards the end of the year. So the answer to your question is yes, we're still optimistic, but we're keeping client some powder dry for clients, and we're basically on a buy footing, not a sell footing at the moment. Yeah.
As a firm, you have amazing access to some people in and around financial markets that are quite powerful and influential. And I know one of your recent events, you had Janet Yellen was there speaking, a number of the board members of the Fed Reserve, I believe. And they talked to this issue about the inverted yield curve, and that they didn't feel like it was necessarily the same, that the harbinger of doom or recession that it has been in the past. So I wondering if you could just sort of summarise or condense sort of what they think is happening there, because we're reading just about every other day an article saying, here comes the recession. Earlier this week, I think JP Morgan put out a recession 9 months from now, which is pretty alarming for a lot of investors to read. So I'd be keen to get your take on what those people that are very close to the Fed are saying.
Yep. They said three things, and in summary, all three of them, so we had Janet Yellen and two current Fed presidents, and they all said that if rates have to go to zero in the States, they will. They also said that in terms of money printing, if they have to turn the taps on again, they will. And related to that, they talked about, well, how much money printing could we do? And the answer, they didn't say it explicitly, but Rosengren, the president of the Boston Fed, he said, he basically spent his whole presentation talking about what they could do is whatever they want to do. So I interpret that as unlimited.
As much as we need to do.
As much as we need to do. So that's quite dramatic. But the third thing, so they talked about, Janet Yellen talked a lot about the inverted yield curve. And again, all three of them said the same thing. It was like they were reading from the same script.
Yeah. Just for clarification for people, inverted yield curve means the longer end, the 10 years, the yield is lower than the front end.
Yeah, because the bond market, in all their wisdom, are factoring in rate cuts are required at the short end to prevent a recession further down the track. So that's right. So Janet Yellen was saying the flat yield curve is structural, and she said the Fed's not exactly, there's a few reasons for it, and they wouldn't pin it on any particular reason. It was why the curve is flat, and it's a structural issue. But she said a couple of things. Firstly, the ongoing psychological impact of the GFC. So employees still feel uneasy about it. They're not as willing to go for wage rises. Wage rises are harder to get, not only because of a lack of confidence on the part of employees, but also technology, the impact of the internet. She mentioned, or someone at the conference mentioned, which I thought was quite interesting, is like when we had the railways being built in the States, it created hundreds of thousands of jobs. But with Google, how many jobs has it created, and how many jobs have been lost on the other side, with digitisation of retail and all the rest of it. So wage increases are harder to come by, and that flows through to inflation. So inflation is structurally lower. The other thing is demographic change. So in developed economies, we're getting older. The Chinese are getting older too, interestingly. So they freed up they had the one-child policy. Now it's you can have two,
Yeah.
but actually not many people are taking it up. And that's what happens as economies get wealthier. It's just people have less babies. So older demographic and a demand for capital stable dividend or interest paying investments. So there's a lot of demand for bonds and the like, and that's pushing yields down. So a few things like that. So that she was saying it's structural. If it goes into inversion month to month or quarter to quarter, her view was it's no big deal. It doesn't mean that there's a recession coming. And given what we took a lot of optimism away from that particular conference because it emphasised to us the Fed put appears to be well and truly in place, that if things that bad news is good news. We're back to that situation. The worse things get, the more likely the Fed to step in. And one of the things I learned, you're talking about my career in the early days, is don't fight the Fed.
So from a asset allocation perspective in terms of where you are finding opportunities, and you talked that you remained with a buy bias rather than a sell bias. In your typical sort of asset allocation or your sort of your main view, your balance view, can you give me a sense as to where you sit in growth assets versus defensive assets, and maybe some of the areas where you feel like there's better opportunities and some of the asset classes or regions that you're avoiding?
Probably the baseline view we have is ABC, anything but cash. And the reason I say that is because yields are falling all around the world. Official rates are falling. So all-time low in Australia, and Governor Lowe, excuse the pun, said that it would be reasonable to assume that there will be another cut.
Yeah.
Okay, so we're going to 1%. So that's a poor outcome for cash. It's a good outcome for bonds. And the beauty of bonds is you're achieving or you're earning a better coupon than what you're getting on cash, but also it acts as a buffer to weakness in shares. So typically, when you get weakness in shares, bonds are a good place to be. They're protecting your money, assuming that you've got some good quality bonds in there. And typically when share markets are coming off, yields are falling because there's some negativity around the economy.
Yep.
And that's good for bond valuations. On the share front, our favoured region is the US and also emerging markets. The US economy is clearly the strongest in the developed world, and because of our faith that China has the firepower they need to stimulate their economy when they need it, we're favouring emerging markets, but particularly we still quite like China.
Mm-hmm. That's interesting because they've been quite out of favour, the Chinese equities.
Yeah, so as a result of the tariff issues, so they've had a good year, but just in the last few weeks they've been selling off, mainly because of the tariff issue. And there is some economic data that's showing that the stimulus that they did at the end of last year seems to be playing out a bit. Mm-hmm. But the Chinese, they will just do what they have to do. Yeah, that's right. That's the beauty of a command and control economy. If they want to build a road, they just go, we will build the road, and they do it. Mm-hmm. The environmental impact statements are usually pretty short documents, so they just get on with it. Yeah.
So long US equities and emerging markets?
Markets, yep. Full allocation to bonds. Yep. Underweight cash. There's no point in having cash in the bank because you're not going to be earning much at all on it.
Yep.
And the other thing, we've had clients, and even not-for-profits, there's a bit of an interesting trend, and I blame the Future Fund. So everyone looks at the Future Fund with 40% in unlisted investments, be it property, private equity, infrastructure. They've also got timber, and they've had tremendous returns, very good returns for the risk that they take. It's good. So we've had a lot of inquiries about, well, how do we access some of the unlisted opportunities out there? And it was just interesting that not-for-profits who know that they don't need the liquidity, because that's the trade-off with unlisted, it's the liquidity. Often you've got to lock yourself in for 4, 5, 6 years, whatever it is. So they're asking us, how do we get, if we're saying, okay, we've probably got sideways markets for the next 3, 4, 5 months. Equities are a bit stretched, although we're more optimistic towards the end of the year, but thinking longer term is now a good time to be diversifying into some of these unlisted things. What we're showing to clients, or what we're able to, is ways for even smaller clients to access private equity through feeder funds. And the way you want to do it is, if you are accessing private equity, you need to be able to spread across managers, and you need to commit to vintages, so investing annually for say 3, 4, 5 years, because private equity, there are good times and bad times for private equity. So the idea is you average across managers and you average across years, and you should get, history says you'll get a good outcome. But you've got to have access to the vehicles to be able to do that, and they are around. Yep.
Is there anything that looks screamingly expensive? There was a lot towards the end of last year. People were talking about high yield as being, some of the credit markets as looking really expensive. Is there anything that you're sort of saying that looks really dangerous to me, or it looks excessively valued that you're steering well clear of? I know you've talked about staying out of cash because it doesn't look like a good return.
Oh yeah.
But aside from that, expensive markets.
I think I'm a bit worried about what they call them, the wax stocks in Australia.
The high growth stocks.
We like technology as a long-term theme, but the issue with Australia is there's a rarity premium. So we don't have much of a technology sector. So some of these stocks are very highly valued. Also, I'm a bit concerned that some investors out there really don't understand them. Not all technology stocks are alike. So, I just wonder if there are investors out there buying things like Afterpay without really understanding what they do and why they do it, and what are the risks.
Yeah.
And so I think there's some issues. There's some issues there. Anything in the tech. I've been through the tech wreck. I've been through the GFC, and the worst thing someone can say is it's different this time. It's never different. So if there is a shakeout, we always ask ourselves, what if we're wrong? We're feeling optimistic. What if we're wrong? If there's a shakeout, where's it going to hit? And it's going to be those technology stocks that aren't making a profit. If they're making a profit, and you can see the cash conversion, then that tells you that the risk is lower, and they'll be okay. They've got something in their model that means there'll be good long-term investments, and you'd buy them on the dip. I remember in the tech wreck, I'll finish on this, and I was sitting there with my boss, and all these new floats were coming across in 2000 related to the internet. And this one came across, and it was to buy fish and seafood, to buy seafood over the internet. And this thing went like a rocket, and within 2 years it was broke. So I think when you start getting things like that, buyer beware.
Time to step back.
That's it.
I always like to finish up when we have a chat with people that have been in and around markets for an extended period and have seen a lot of things come and go. Be good to get you to reflect on a mistake that you've made in your own days investing, and potentially something where you learned a lesson the tough way, and that it stuck with you, that you think holds you in good stead as an investor, as a CIO now. Yeah,
sure. So back in the day, when I was in Aussie equities, when I was just looking at Aussie equities, I think I could rightly be criticised for falling in love with stocks. And back in sort of 2000, there were two stocks in particular, CSL and Cochlear, just couldn't do anything wrong in my eyes. And the valuations got ridiculous looking back. They had PEs, high 40s back then. And a few things happened. Yields rose, and that's not good for high PE stocks. There was a lack of optimism because of the tech wreck. Anything with a high PE, if it was healthcare or tech, it didn't matter. They were hammered. And the other thing, unfortunately, at the time, CSL and Cochlear were going through some short-term earnings, some drawbacks for their earnings. So what I learnt is it's good to have a growth philosophy, but you do need to incorporate some sort of sense of valuation and really understand, okay, if this stock doesn't produce the earnings that the market expects, what could happen? It could be a dramatic fall. So that's what I learned. Always have a sense of valuation, and don't get stuck in the mud and convince yourself you're right. Have a flexibility of mind and be willing to say, actually, you know what? Let's just reduce it. It's not going our way. We do think that eventually it'll turn around, but why take the pain and take some risk off the table?
Be willing to cut a position if you have to.
That's exactly it, yeah. That's right.
Well, Andrew, thanks very much for coming in. Great to hear a bit about your background and an update in what's a pretty dynamic environment at the moment.
Terrific. Thanks, mate.